In the world of finance, few names invoke as much infamy as Bernie Madoff. Madoff was a trusted figure on Wall Street, but he was far from an ordinary hedge fund manager. He was the former Nasdaq chairman and the founder of the Wall Street firm Bernard L. Madoff Investment Securities, LLC. By 2008, his firm had become the sixth largest market maker in the S&P 500 stocks. But beneath his polished image lay a carefully constructed web of lies, fake trades, and fabricated accounting statements. Bernie Madoff and his investment company masterminded the largest Ponzi scheme in history, worth an estimated $65 billion. It was a simple yet devastating operation of lies, taking money from new investors to pay returns to earlier ones. When the scheme finally collapsed during the financial crisis of 2008, it devastated thousands of lives and actually sent shockwaves through the financial industry. The reason why Madoff's investment fund became so popular was its stable, consistent returns. I believe it was said that Bernie's returns were around 10% annually, regardless of whether the market was up or down. So if you give him $100,000 at the beginning of the year, within 12 months' time, you would have $110,000, regardless of how the market was doing. So Bernie claimed that his steady returns were due to something called a split strike conversion strategy. And somehow his approach seemed to work, even if other strategies failed worldwide. And except for a few whistleblowers, most people and even the SEC did not question Bernie, probably because of his stellar reputation at the time. But the truth is, Bernie should have been caught a long time ago. Why? Because it's pretty easy to prove that the returns he was claiming was one big fat lie. And all someone had to do was a bit of math. And in this video, we are going to prove how his investment performance numbers were not just unlikely, they were mathematically impossible. To understand the scale of Madoff's fraud, we first need to understand the man himself. Madoff was born in 1938 and grew up in a predominantly Jewish neighborhood, Queens, New York. Bernie Madoff started his career in finance in the early 1960s. He founded Bernard L. Madoff Investment Securities, LLC in 1960, a firm that would eventually become a powerhouse on Wall Street. Initially, Madoff specialized in penny stocks, which were low-priced shares traded on the over-the-counter market. And pre-scandal, Madoff wasn't just a trader, he was a visionary. Alongside his brother Peter, he developed an early computer-based trading software, which was a technological advancement that later Nasdaq would adopt. And this innovation laid the groundwork for the electronic trading systems that we use today in the stock markets. And by the early 90s, Madoff's influence in the industry earned him the position of the Nasdaq chairman. His reputation as a visionary leader and entrepreneur solidified. The position of Nasdaq chairman gave Bernie the aura of authority and trustworthiness. Investors, large and small, believed in him because of his long-standing credibility within the financial market. By the 1990s, Madoff's brokerage firm was handling around 10 to 15% of all trading orders on the New York Stock Exchange. He was also known as a philanthropist. He donated generously to charities. He also contributed significantly to political campaigns, especially within the Democratic Party. By the early 2000s, Madoff's firm was known for its seemingly unbeatable track record. Madoff's firm was a family business. Bernie's firm employed Bernie's brother Peter as a senior managing director as well as a chief compliance officer. Peter's daughter, Bernie's niece, known as Shayna Madoff, was also working there as a rules and compliance officer. Madoff's sons, Mark and Andrew, worked in the trading section of the business as well. The business had clients that included hedge funds, banks, charities, celebrities, and even your everyday retirees. And again, it was because of his reputation for delivering steady, stable returns, no matter the market conditions. It just made him a sought-after figure in the investment world. And by 2000, Madoff Securities, which was one of the top traders in the US securities, held around $300 million in assets. But we all know this was one big lie. So how does someone so trusted, so celebrated, deceive the financial world for decades? Personally, I think the answer lies in a combination of investor trust, financial complexity of a so-called model, and Madoff's own mastery at perception. These skills allowed him to orchestrate the largest Ponzi scheme in history. So how did he do it? But before we find out, here's a quick word from today's sponsor. Big thanks to today's sponsor, CyberGhost VPN. With over 38 million users and an amazing Trustpilot rating, CyberGhost is killing it when it comes to keeping your online activity safe and private. 20,000 people have already given it top marks, and here's why it's worth checking out. If you're serious about your online privacy, a VPN is non-negotiable. I use a VPN, and no, incognito mode doesn't cut it. Your ISP, school, work, and even websites you visit, they can still track what you're doing. Incognito mode just hides your browser history, not your online activity. That's why I use CyberGhost VPN. It encrypts all your internet traffic and routes it through secure servers, so you're practically invisible online. They've got servers in over 100 countries, which means you can access content from anywhere. Want to see what other countries' Netflix or Amazon Prime has to offer? Well, you can. With CyberGhost, you can unlock streaming content from 40 plus streaming platforms, like it's no big deal. This app works on any device: Windows, Mac, Android, iOS. You can protect up to 7 devices in one account. That's plenty to cover your phone, your laptop, and even share with a couple of friends and family. And get this, CyberGhost doesn't keep any logs. That means even they don't want to know what you're doing. Total online privacy. Right now, you can get CyberGhost VPN for just $2.03 a month, plus 4 months free. That's a huge 83% off. And with a 45-day money-back guarantee, there's literally no risk. So if you're ready to take control of your online privacy, hit the link in the description to get started with CyberGhost VPN today. And now back to the video. So Madoff's investment company looked very promising to investors. They knew that if they gave Bernie their money to invest, their money would grow regardless of the economic conditions. And yes, I know it sounds too good to be true, but just remember at the time, Bernie had a stellar reputation. He was well known in the financial industry. So to understand why Bernie's claims were too good to be true and to understand the math behind it, it's important to understand how a legitimate investment business works, which I'm sure most people do, but for the purpose of the video, here's an explanation. So when you invest your money with a typical fund or an investment manager, your funds are pooled together with other investors' money and used to purchase actual assets. These might include stocks, bonds, real estate, or other financial instruments. And the performance of these investments are directly tied to the economic conditions or the market conditions. So, for example, if you invest $10,000 in a mutual fund, the fund manager might allocate $6,000 to large cap tech stocks, $2,000 to government bonds, and $2,000 to emerging markets. And over time, your returns are based on how these assets perform. Some years you might see a strong 15% gain. Other years, maybe the market dips because of bad economy, war, etc. And your returns could be closer to minus 5%. So that's where you are losing money. And that is because the market is unpredictable. And even the smartest investors in the world can't guarantee consistent positive returns year on year. Now, contrast this explanation with Bernie's magic returns. Madoff's business looked like an investor's dream come true on the outside. He claimed to use a split strike conversion strategy. And this is a complicated investment technique that I'll speak a bit more later on. But he claimed to use this complex strategy to do the trading. And here is where it gets really interesting. Madoff consistently reported returns of about 10% every year, no matter what the broader market was doing. Whether the stock market soared, whether the stock market crashed, Madoff's clients always saw really steady, positive, but modest growth. To put this in perspective, during periods of extreme market volatility, like the dot-com bubble burst in the early 2000s, most investors suffered losses, or maybe at best they broke even. But Madoff's clients were earning smooth, uninterrupted profits. Again, it was very modest, so it wasn't like you were going to get super rich with extreme gains investing your money in Madoff. It was just a safe investment, but still a bit too good to be true. So what was Madoff really doing? Instead of actually investing the money that he was given, Madoff was just running a plain old-fashioned Ponzi scheme. So here's how it worked. New investors coming in would deposit money into Madoff's fund. And instead of using this money to actually buy stocks or options as promised, Madoff kept it in his own personal bank account. And when older investors wanted to withdraw their profits, Madoff simply used the incoming funds from new investors to pay your old investors. So for instance, investor A gives Madoff $1 million. Madoff doesn't even invest this money, he puts it in his bank account. A few months later, investor B joins the fund and gives Bernie $2 million. When investor A asks to draw their now $1.1 million investment, Madoff takes part of investor B's money to pay that older investor. And the system will work because as long as you have new money flowing in, Madoff could keep that illusion of success. But remember, no actual investments were happening. The money was just being shuffled around. Now you might ask, well, how did he get away with it for so long? Madoff's scheme lasted for decades because he just cultivated trust. He really did target his inner circle. So this wasn't just any investment scheme that anyone could join. And his inner circle consisted of the Jewish community. Bernie's family was Jewish. Wealthy friends, charities, and institutions who were unlikely to question him. And because all his clients were either friends with him or knew of him through their other friends who had successful investments with Bernie, nobody actually questioned him. Also, when a new investor approached Bernie and asked Bernie to invest their money, Bernie often declined. He deliberately limited access to his fund, making it quite exclusive and elite. And eventually, people got desperate and almost started begging for Bernie to invest their money. And now you might be thinking, well, surely someone could have known and said something. And that was true. There were quite a few people who suspected that Bernie's operation was a red flag. And the SEC did investigate him on several occasions, but the actual effort was really superficial and just poorly executed. And again, it was just overlooked, probably because of Bernie's reputation. But ultimately, no Ponzi scheme can last forever. So when the 2008 financial crisis hit, many of Bernie's clients wanted to withdraw their investments from Bernie's company. And with no new investors coming in to cover those payouts, the house of cards finally came crashing down. He just reached the stage where he didn't have enough money to pay off all of the withdrawals. So on December 10th, 2008, Bernie Madoff admitted that he was finished and that the asset management arm of the firm was in fact a Ponzi scheme. As he put it, one big lie. His sons, Mark and Andrew, then reported him to the authorities once he confessed to them. So Bernie was caught only because he admitted to his crime. But was it possible to mathematically prove that Bernie's returns that he claimed were all false? It's not only possible, it's glaringly obvious. So by 2008, Bernie had appeared to build a highly successful investment management company. And he says he was successful because he claimed to use a specific strategy called the split strike conversion strategy. Clients practically lined up to hand Bernie Madoff their money because Madoff seemed to deliver high returns always. But what does high returns exactly mean? In simple terms, a return is the amount of money that you earn or lose on an investment over a period of time. It's often expressed as a percentage. So if you invest $10,000 and you earn a 10% return, you now have $11,000, a $1,000 gain. If you have a minus 5% annual return, i.e. you lose 5%, then your investment is now at $9,500. So let's look at some actual data. Let's take a look at some numbers from one of Bernie Madoff's clients, known as Fairfield Sentry. Fairfield Sentry was one of Madoff's largest feeder funds. They pool money from investors around the world and hand it over to Madoff to manage the investment, sort of like a middleman. Their relationship with Bernie funneled billions of dollars into his scheme. Fairfield Sentry was one of the key players. So if we look at a snapshot of Fairfield Sentry's returns that were reportedly all managed by Bernie Madoff, we can look at the data between 1990 and 2008 before the financial crisis hit. And as you can see, the returns were quite consistent. Month after month, Madoff's reported monthly returns hovered around 0.5% to about 2%. But if you look at the table, you can notice something quite strange. The losses were almost non-existent. So for example, in the 18 years shown, there's only a handful of negative months, such as February 1994 and August 2006. It's too few. And for context, even the best performing hedge funds have their ups and downs quite continuously. Markets are unpredictable, and losses, sometimes significant ones, are the real part of investing. Yet Madoff's performance always appeared to be perfectly modest and stable. And we know that this is all fake. But let's pretend we don't know this. Let's pretend that we see these figures from Fairfield Sentry. And we know that Fairfield Sentry used Bernie Madoff to manage their money. And we just want to figure out if his investment strategy is legit, because it just seems to be clearly working. How would we do this? To understand how Bernie Madoff's investment scam worked, we first need to break down the strategy he claimed to have used, which was something called the split strike conversion strategy. Sometimes it's known as a collar strategy as well. Now, Madoff has not gone into detail on his specific strategy. He claimed it was part of his own intellectual property. But he did claim to use a split strike conversion strategy. And when people asked how has he been so successful, Madoff basically told investors that this was the strategy he used, but he didn't ever go into too much detail. But this is how a split strike strategy would work. It employs the concept of using three key components to keep your money safe while still being able to grow it. So you start off with buying stocks, good, reliable blue chip stocks. So these blue chip stocks are large, stable company stocks, like the ones you see in S&P 100 or S&P 500. This is known as a market index. So a market index like the S&P 100 or the S&P 500 is simply a group of companies that represent how well or poorly the overall market is doing. So, for example, if the S&P 100 goes up, it means that the largest 100 companies in the US are doing well. If it goes down, we know the companies are struggling across the board. So buying these blue chip stocks are a safe bet. They may not make you rich overnight, but they also just don't collapse easily. And I think it's important to know that all of Bernie's investors were not looking to get rich overnight. They wanted long-term, stable investments. The second element of the split strike conversion strategy is known as buying protective put, in brackets, options. Almost like insurance for your portfolio of stocks. So here's how this works. Imagine that you own a car worth $10,000. You buy insurance so that if the value drops to $7,000, you can still sell it for $9,000. In the stock market, a put option actually lets you lock in a price to sell your stocks, even if the value drops below a certain level. So if the market went down, Madoff will claim, oh, well, it's the put options that he has bought. Those would limit the losses for the clients, which is why they didn't really suffer any significant losses during the years that they invest with him. And the last element of the split strike strategy was selling call options. A call option is where you let someone else buy your stock if it reaches a specific price. And in exchange, you get paid upfront, which is known as a premium. Think of it like renting your house. You earn rent money, the premium, but you're agreeing that someone can buy your house if that price actually reaches a specific level. So Madoff will sell these call options to help pay for the cost of the put options, creating the safety net for his investors. So breaking all of that down in really simple terms, let's say Madoff bought stocks for $100 each. To protect himself, if the prices fell, he bought a put option that let him sell the stock at $90, even if that stock could drop lower. To earn some extra cash, he sold a call option so that someone else could buy the stock for $110. So if the stock would always be priced at $90 to $110, Madoff claimed that his strategy would work perfectly. Investors just wouldn't lose that much money if the prices dropped, and they would still make some money if the prices went up. So again, modest, stable return. It's a lot more complicated than that, but this is what people generally assumed he was doing, specifically because he did talk about this strategy. But like I said, he wasn't really transparent with the details of it because obviously he wasn't doing it. Now, this strategy is a real strategy, but it has one downside. It actually limits the amount of money that you can make. So if the market does skyrocket and shoot up, you don't enjoy all of those gains because of the call options that you sold. And if the market does crash, you still lose money. It's just capped. So in a real world, a split strike conversion strategy can lead to moderate but inconsistent returns. You can make money, but you also can lose money. But Madoff wasn't really reporting moderate and inconsistent returns. He was always reporting smooth, consistent returns, no matter what the market was doing. So naturally, once his big lie was all found out, a lot of mathematical experts tried to replicate Madoff's returns using the historical data and real split strike strategies. No one could even get close to his performance. It simply wasn't possible, which leads us to the crux of this video. How would mathematic experts try to replicate Madoff's performance? So let's say Bernie Madoff's returns were called into question, and we just wanted to investigate if this is really legit. How would one figure that out? So what you would want to see is if his reported performance could be achieved by any means, especially using the split strike conversion strategy that he claimed to have used. Now, there is a research paper which goes into this in detail. If you're interested, highly recommend it. It's called Mr. Madoff's Amazing Returns, an analysis of the split strike conversion strategy. I'll share the link in the description. I'll be quoting a lot of their calculations and figures from this paper. But anyway, if we do want to prove that Bernie's figures are a lie, we would need to figure out benchmarks, specific metrics to measure his performance, and benchmark this with the performance of other common investment strategies. This is a common process in data analytics. And you can even do this with your own investment portfolios, except the split strike conversion strategy is a bit more complicated. But let's start by defining main metrics that we would look at in order to determine if a specific strategy is performing well against other common strategies, or if there are any red flags. The first one you look at is annual return. So let's compare the annual return of the different investment strategies over the period of December 1990 to 2008. So these were the years that Bernie was active and trading. So the first thing we do is actually calculate the annual return by investing in the S&P 500. So if we had to just dump money into the S&P 500 index, what would we make? That is the question we're asking. Between these periods, the annual return would be 9.46%. So this is what I've calculated using a basic calculation and drawing data from Google Finance. I'll share the spreadsheet with you if you are interested in the formulas. The research paper I spoke about earlier got 9.64%. So again, if you just invested in the S&P 500, your annual return would be on average 9.46%. Next, we can compare this with the annual return using a split strike strategy, which Bernie claimed to be using. So if Bernie Madoff had to use a legit split strike strategy to invest the money, what would the annual return look like? So to estimate the returns for a legit split strike strategy, It's actually quite complicated. We use something called the expected return formula. Now, this formula is quite intense, but basically to calculate the expected returns from a estimated split strike conversion strategy, you would need other data from the stock market. You would then pipe this other data into the formula and it would give you an expected return. So we would need things like the initial stock price, the expected market growth during the time period, which is usually about 8%, the average call and put options you used, which can be determined by other formulas, a risk-free rate, etc. Now you'll be able to get this information from historical data from the stock market, and you would just pipe this into the formula. Now I did try to do this myself on Python, and I couldn't get the correct figures, unfortunately. But in my defense, I've only looked at it for about an hour, and at this stage, I trusted the research paper with the figures that they've got. Now, there are actually two versions of a split strike conversion strategy, almost like a best case scenario and a more realistic case scenario. So there is split strike without volatility skew, and this just assumes that the put and call options are symmetrically priced, meaning that the cost of protecting against losses is offset by the income of selling calls. So think of it like insuring your house, which is buying puts, and renting out a room, which is selling calls. The rent covers your insurance costs completely, leaving you with stable, moderate returns. It's a bit of an unlikely scenario, obviously, because we know that the market is unpredictable, it changes, you lose money. The other one is a split strike with volatility skew. So that is a lot more realistic because in real markets, put options are more expensive than call options because investors generally fear losses more than they expect gains. There's more risk when it comes to a loss. So there are specific calculations for these two different models. And like I said, one will give you an annual return for a best case unrealistic scenario, and one will give you an annual return for a more realistic scenario. So the annual return for your split strike without skew, i.e. best case unrealistic scenario, would be 11.68%. So slightly higher than the S&P 500 due to that stable options pricing. And then if you use a split strike with skew, more realistic scenario, your annual return drops to 6.83% because there is that added cost of protecting against losses in the real market. So if Bernie actually used a split strike conversion strategy, at best case scenario, he would have received an 11.68%. So possible, but a very unlikely situation. And in a more realistic case, his returns would be around 6.83%. But what was the actual return that Bernie claimed to have made? Well, finally, we can look at the data from Fairfield Sentry, which was one of Bernie's clients or investors. You can calculate the annual return from the data provided. And here, Bernie Madoff reported a return of about 10.59% for this fund. And at first glance, it looks reasonable. It's nothing sky high. It's higher than the S&P, but lower than a best case split strike strategy. But this is only part of the story. You can't only look at one metric, the annual returns. There are others. So like anything with data analytics, when you are comparing different methods or strategies, you won't only look at one metric. Likewise, annual returns don't tell you the full story. You have to look at other things. So next we examine something called risk, often measured as volatility, which shows how much an investment changes or fluctuates. It's given by the formula below, and all you need is the returns for a specific fixed period to calculate it. So risk volatility actually shows how much a return can change or fluctuate over time. So for instance, if I tell you, hey, invest with me, my average return for the year is 10%, but you look at my data and you see that for some months, it will be minus 40%, and some months it will be plus 60%. And even though it averages at 10% across the year, it actually fluctuates a lot during the year. That's not stable. That's a high-risk investment. Markets generally aren't very stable. They're not smooth. There are always dips and there's peaks. So if we calculate risk volatility for the different strategies, this is what we get. For the S&P 500, again, if we just had to dump our money into the S&P 500, the annual volatility would be 14.28%. This seems like a typical level of risks for stocks. If we had to use a split strike conversion strategy without volatility, it would drop to about 10.72% risk, showing that this strategy reduces the risk compared to S&P. But again, the split strike conversion strategy without volatility, that calculation represents a market that doesn't really change and that's quite stable, which is, again, unrealistic. If we invest our money with a split strike conversion strategy with volatility, it's slightly higher at 10.85%, so the risk is slightly higher. But all in all, if we had to invest our money in a split strike strategy that is legit, it will be around 10% risk. Now, using Bernie's data, using the Fairfield Sentry data, if we had to perform the volatility calculation, well, Madoff reported a volatility of 2.45%, unbelievably low. So it suggests that the returns were always smooth and stable, which is just impossible. And this was also performing well below the risk of an S&P 500. Big red flag. But again, you can still look at other metrics. So far, it seems like Madoff's returns were beyond the norm. But there is another metric that we can look at, known as the Sharpe ratio. The Sharpe ratio measures how good an investment is by looking at how much extra return it gives you per one level of risk. So if you get a high Sharpe ratio, it means that you have more reward for every unit of risk. And a low Sharpe ratio means that there is less reward for the risk that you're taking. So what does it matter? Well, imagine that we have two investments. Investment A gives you a return of 10%, but it's quite risky. It swings wildly between gains and losses. Investment B gives you an 8% return, but it's less risky. It's a lot more stable. Now, investment B would be a lower Sharpe ratio as it provides less returns, but also less risk. It's given by this formula, and all you would need to input is the average return, risk-free rate. So usually you can use a baseline return that has no risk, such as treasury bond rates, which are at 4%. And you need the volatility or the risk, which we've just calculated before. And if you do this calculation, these are the Sharpe ratios and how they compare. And immediately, you can see the Sharpe ratio between the S&P 500 and the split strike conversion strategies are all less than 1. The split strike conversion strategy without volatility skews at 0.6, which again, unrealistic scenario because there's no volatility, but still gives you a Sharpe ratio of 0.6. A more realistic scenario would be just the S&P 500 Sharpe ratio at 0.363, but all in all, around the same level. And this is Fairfield Sentry, which is Bernie Madoff's clients, 2.46. This is just off the charts, completely unrealistic. It's just so far off from any reasonable strategy. And lastly, probably the easiest metric we can look at is something called consistency. Consistency measures how often the investment delivers positive returns, i.e. it doesn't lose money. And it's expressed as a percentage of months with positive returns. It's given by this formula here. And investments with higher consistencies appear to be less risky. However, perfect consistency is really unrealistic. You can't have most of your months being positive where you always make money. So if my investment fund had a consistency of 70%, that means that 70% of the months in a specific period, I've actually increased my investment. My investment has made money. And looking at the consistency for the S&P 500, within the time period, we have a consistency of 64.65%, meaning around 2 out of 3 months are profitable. And 1 out of 3 months, you will probably get negative returns or you'll lose money. If we look at the split strike strategies, both versions have positive months or consistency of around 64%. Again, quite similar to the S&P 500. It aligns with market behavior. Again, 1 in 3 months are generally negative where you will lose money. Fairfield Sentry, Madoff's fund, had positive months of 92.09%, meaning almost every month was profitable. And the lack of negative months here is a clear red flag, especially if your S&P 500 is at 64%, and those represent the 500 largest companies. and there's no strategy that avoids losses completely. So in summary, we have annual returns, which were very optimistic, to put it mildly, and were quite smooth as well. So again, if you plot this on a chart, the smoothness of the line, the lack of dips and peaks, which is what any scenario would have, especially in a stock market, is not there. His Sharpe ratio was too good to be true. The risk was also a bit too good to be true. And lastly, he just seemed to always have positive months, almost like he was a time traveler who just predicted really correctly what the stock market would always do. And this was plain old-fashioned math, which does not lie when you compare it to other strategies. And one person actually did the math before Bernie even admitted to his crimes, which was Harry Markopolos. He produced a report to the SEC, which had 29 red flags. And I'll link the report below. But to Markopolos and anyone familiar with financial mathematics, having a smooth, steady return, like what Bernie Madoff was claiming, just simply could not exist in your legitimate practice. And it really is unbelievable how Bernie Madoff actually got away with this. But really good and interesting use case, and learning the math behind this is quite beneficial, especially if you have your own investment funds as well. So the important lesson here is that regardless of what someone says, you can always find the truth in some math, maybe some coding. Thank you so much for watching. If you like my content, please like, comment, and subscribe. And don't forget to click on the description link to get the special discount that CyberGhost VPN is granting our channel users. This application will protect your data while you browse and give you full access to all blocked content on the internet for $2.03 a month only. Totally risk-free, so check it out. Link is in the description. I'll see you on the next one. Bye.